pull a quarter out of your pocket. Look at it now. Find a 1964 quarter, one minted before the government quietly changed everything. That older coin, worth 25 cents on paper, is worth around $5 today in silver alone. Same denomination, same face value, completely different reality. What happened between 1964 and 1965 wasn't just a change in coin composition. It was one of the most consequential and least discussed financial decisions in American history. And the official story, it was a lie. Today, we're going to break down exactly what happened, why it happened, and what it means for your money right now. In 1965, President Lyndon B signed the Coinage Act into law. The official explanation from the White House was simple. America was experiencing a coin shortage. A booming post-war economy, the rise of vending machines, and coin collectors were allegedly pulling change out of circulation faster than the US Mint could produce it. So, the solution, they said, was to swap out the silver. Dimes and quarters went from 90% silver to a clad sandwich of copper and nickel metals that cost virtually nothing compared to silver. The public called them Johnson's sandwiches. The name stuck. But here's where the story falls apart. If there was truly just a supply problem, why didn't the government simply mint more silver coins? The US Treasury held over 2 billion ounces of silver in the late 1950s. That's not a shortage. That's a stockpile. The real answer lies in a 250-year-old economic principle called Gresham's law. Bad money drives out good. When two forms of currency circulate at the same face value, one made of something valuable, the other made of something cheap, people instinctively spend the cheap stuff and hoard the good stuff. And in the early 1960s, that's exactly what was happening. Here's the math the government didn't want you to think about. The US dollar was pegged to silver at $1.29 per ounce. That meant every quarter contained roughly 18 cents worth of silver at that fixed rate. Fine, as long as the market price of silver stayed below that peg. But the industrial world was exploding with demand. Photography, electronics, batteries. Companies like Eastman Kodak alone were consuming enormous quantities of silver. Global demand was pushing prices higher. The Treasury saw the math coming. If the market price of silver broke above $1.38 per ounce, the metal inside a quarter would be worth more than 25 cents. At that point, every rational American would melt down their pocket change and sell the metal. The nation's coin supply would literally disappear into smelters. So what did the Treasury do? They started selling off their own stockpile to suppress the price. They were manually holding the price of silver at $1.29 by flooding the market with government reserves, bleeding billions of ounces in the process. By 1965, that 2 billion ounce reserve had been drained to dangerously low levels. The government wasn't running out of coins. It was running out of silver to keep the bluff going. And at the same time, foreign governments, industrial giants, and sharp-eyed investors all saw what was happening. They were buying silver from the US Treasury at the artificially suppressed price, knowing the peg would eventually break. It was, in financial terms, a risk-free trade. And America was on the losing side of it. When LBJ signed the Coinage Act, he stood before the cameras and said, and I am paraphrasing, that anyone thinking about hoarding silver coins should think again. He insisted the Treasury had plenty of silver and would use it to keep prices stable. There would be no profit, he claimed, in holding the old coins. It was a bluff, and the president knew it. Just 3 years later, in June 1968, the government quietly dropped a price peg entirely. Americans had a final deadline to exchange their silver certificates. Those old blue-sealed dollar bills that literally said payable in silver for actual metal. People lined up around the block at SI offices in San Francisco and New York, desperate to trade paper for physical silver. The Treasury had already run so low they couldn't hand out bars anymore. They were giving people small pouches of silver granules. Those who believed the president and kept spending their silver quarters, they lost. Those who ignored the government, held the coins, or cashed in their silver certificates before the June 1968 deadline, they won in a big way. By 1980, silver hit $50 an ounce. The metal LBJ said was worth $1.29 had increased nearly 40 times in value. The citizens who trusted the government's money lost almost everything relative to silver. The citizens who hoarded preserved their wealth. Here's the context that makes this story even more significant. In the mid-1960s, the US government was simultaneously funding two enormous programs: the Great Society welfare expansion under LBJ and the escalating war in Vietnam. Both required massive amounts of money. The Federal Reserve was printing to keep up. But here's the problem. You cannot run unchecked inflation when your money is made of silver. If the government prints too much paper while coins are still silver, Gresham's law kicks in immediately. The silver disappears from circulation, trade slows, and the economy seizes up. Silver was the circuit breaker. By removing silver from the coinage in 1965, the government removed that circuit breaker. They cleared the path for the Federal Reserve to expand the money supply without any physical constraint. The great inflation of the 1970s, where prices tripled and interest rates eventually hit 20%, was made possible by what happened in 1965. They blamed OPEC, they blamed unions, they blamed consumer greed. But the underlying cause was mathematical: the removal of the hard anchor from the currency. And the social consequences went beyond economics. Before 1965, saving money meant literally hoarding coins. A jar of quarters was a jar of silver, a store of value immune to inflation. You didn't need a bank account or a stockbroker to protect your purchasing power. You just needed a piggy bank after 1965. Saving coins became pointless. Copper and nickel offered no protection from inflation. The middle class was forced into the financial system. If you couldn't save in money, you had to save in products. The bank sold you savings accounts, bonds, stocks. You were forced to hand your capital to institutions that could lend it out. A nation of independent savers became a nation of dependent investors. Want proof? This isn't just theory. Here's a simple experiment you can do yourself. Take a 1964 Washington quarter. In 1964, that coin bought roughly 1 gallon of gasoline. Today, that same coin taken to any coin dealer would get you around $5 based on its silver content alone. And a gallon of gas today, about $5. The price of gasoline hasn't actually changed, not in real terms. In silver, gas costs the same amount of labor and capital to produce and distribute as it did 60 years ago. The only thing that changed is the currency used to measure it. The clad quarter in your pocket has lost more than 95% of its purchasing power since 1965. The silver quarter has preserved 100% of it. Prices aren't going up. The dollar is going down. The removal of silver was the removal of the measuring stick. It broke the thermometer so the government could heat up the room without anyone being able to prove it. Here's where this story stops being history and starts being your present. We are watching the exact same movie play out again, just with cheaper actors. Today, the metal content of a standard US nickel, the copper and nickel inside it, is worth more than 5 cents. Depending on commodity prices, the intrinsic value of a nickel fluctuates between 6 and 7 cents. That means the US Mint is literally losing money on every single nickel it produces. This is called negative signerage. It is a classic early warning signal of currency debasement. History tells us exactly what comes next. The government will debase the nickel. They'll switch the composition to cheap steel or zinc, just as they did with the penny in 1982, when they quietly swapped out the copper for a zinc-coated metal. When they make that announcement, old nickels will vanish from circulation overnight. People who understand Gresham's law will hoard them by the millions. We are watching the setup happen in real time. The legacy of 1965 stretches further than most people realize. Once the public accepted that money had no physical value, that it was just a government-issued token, the transition to digital money became psychologically inevitable. If a coin is just a worthless copper slug, why carry it? Why not use a card, an app, a digital wallet controlled by a central bank? The central bank digital currency, or CBDC, is the logical endpoint of this process. The Coinage Act of 1965 removed the soul of money, the silver. A CBDC removes the body, the cash. Together they complete the transformation from citizen as asset holder to citizen as credit user. In 1964, if you held a silver dollar, you held wealth. No government could switch off. In a CBDC world, your digital balance is a privilege, one that can potentially be restricted, frozen, or programmed with conditions. Meanwhile, the fundamentals for silver itself are arguably stronger today than they were in 1964. Silver is now essential for solar panels, electric vehicles, and advanced electronics. We are consuming silver faster than we can mine it. Above-ground stockpiles are shrinking. When major industrial users cannot secure the physical metal they need, paper price manipulation will eventually collapse under the weight of physical reality. Some market analysts project silver could reach triple-digit prices if that supply crunch arrives. The 1964 quarter wouldn't just be a store of value at that point. It would be the best performing asset in many portfolios. The lesson of 1965 is straightforward. Governments will always choose to default on their promises rather than face the discipline of hard money. They promised the silver certificate was redeemable. They broke that promise in 1968. They promised the new coins were just as good. They were not. They promised to hold the price of silver. They couldn't. And today, governments are making new promises about the stability of the banking system, about inflation being transitory, about the long-term solvency of Social Security. History suggests you should weigh those promises accordingly. The silver window closed in 1968. The gold window closed in 1971, when Nixon ended dollar convertibility entirely. The pattern is consistent. Those who held physical assets, silver coins, gold, tangible stores of value, protected themselves from what followed. Those who trusted the paper did not. The Coinage Act of 1965 was the crime. The 6 decades of inflation that followed were the getaway. The question now is simple. Are you paying for it, or are you opting out? Like, subscribe, and drop a comment. Do you own any pre-1965 silver coins?